All right. So the first point is nothing to do with finance as such, but a general point about program. You remember what is an elegant proof in mathematics in school? You don't remember this concept of an elegant proof? Okay, or a more efficient proof. So if you do, you know proofs, right?
Yes.
So if you do a proof like recently, a Cornell professor, the Indian guy actually, Kaushik Basu, he used to be chief economic advisor. He came up with a really long proof of the Pythagoras theorem. Okay, so unnecessarily inefficient. He was trying to come up with the longest proof or something like that. Okay, so the point is that if you do a proof in, say, let's say 17 steps, and if I can do the same proof in, let's say 6 steps, then my proof is more elegant. That's what we say in mathematics. Okay, we say this is a more elegant proof because I have proved the same thing in fewer steps. Okay, so efficiency, it has a lot of connections to important ideas in the philosophy of science and philosophy in general, which we should write down as well. These are important ideas. It may be a little difficult to grasp initially, but where are we in terms of date? We discussed a little bit about Vega versus expiration yesterday. Where is the date here? Yeah, I put the 1510 here, and yesterday was the 21st class, which is where we covered a little bit of Vega versus expiration. So we'll put this, we covered a lot of other things which are not in the notes, okay, which we, see, I can't even see anything here. 21, this is yesterday was 2110, right? So we covered Vega versus expiration, and today we will cover, before I go into this topic, I just want to start for today. These are important ideas. You should be, because you're an MBA student, you're not just somebody, so since you've done a master's degree in business, you're required to be familiar with these kinds of ideas, okay? These kinds of ways of approaching things, thinking abstract in the abstract about various problems, okay? So the point that we are discussing now, okay, so it will be highlighted here. So the point is the concept of an elegant proof in mathematics. Now you understand what is elegant proof, okay? That is considered a more elegant proof. Okay, so this is also connected to the idea of, you can read up on this later on. I'll just explain briefly what this idea is. So it is also loosely connected to this idea in philosophy, very important principle, and it's very useful in life as well, okay? This principle is called Occam's razor. It's actually, there was a guy called William of Occam in England, okay? So I don't know why the razor came up, but the principle here is that basically the idea here is, it's got many kinds of forms, okay? Or let's say assumptions. Where did this go? Why did it jump up? Okay, I think this display is too big. If I make it 105, can you still read at the back? You can read? Okay, so this is a very crude way of writing it. I'll come up with a better way. Things should not be multiplied beyond, so later on I'll try to rewrite this beyond necessity. Okay. So can you see how the ideas are connected? That I proved the same thing in 7 steps, okay, or 6 steps, and you took 17 steps to prove the same thing. So my proof is much more elegant because the same job can be done, and if you can do it in fewer steps, obviously. So it's not only more elegant, it's also what we would say, you can see clearly there is a normative preference. So it is not just to say that it's elegant. Obviously elegant is a nice word, okay? So therefore what there is also embedded in this idea of a more elegant proof is that there is a normative judgment happening, that a more elegant proof is preferable to a less elegant proof. Are you understanding that as well? Right? So if you do a proof in 17 steps and somebody else does a same proof in 7 steps, that person should get more marks. So his proof is better, so there's a normative judgment. Remember, normative versus positive? We are actually making a statement that your proof is better. It's a higher quality proof because it has fewer steps. Is this clear? So you've learned this new term, elegant proof in mathematics. Okay, so can you see also the idea behind Occam's razor? Let me explain this a little bit more. Things should not be multiplied beyond necessity. Can you see already? Because if you did a proof with 17 steps, that means clearly 10 of those steps are unnecessary. Okay, because you could have done the same steps proof in 7 steps. Okay, so this is a very important principle. It's actually from philosophy, but you can see applications everywhere. So wherever, so you can, if you can establish something with maybe with 3 or 4 premises, okay, why should you use 17 premises to establish that same point, right? It makes sense to everybody. So it's always better to be lean. You understand the concept of lean? Lean, we say somebody who is very high fat, is, he's not very lean, right? So fat. So when we were taught English in school, we were taught to write lean muscular prose, which means don't unnecessarily use words which are falling over themselves. You establish the point in very clear and simple language and in very basic and minimalistic terms. Okay, so the expression that was taught to us was lean muscular prose, which is few words, and express the idea in as few words as possible. Okay, so this is the idea that is there in Occam's razor, that you basically don't make, if you are trying to prove something, you only look for those assumptions that are absolutely necessary to establish that proof. You do not unnecessarily make assumptions, like it's in an unrelated way. You see many of the forms that you see in government offices in India, and not just government offices, even private sector does this. People, when they're designing a form, they'll just put everything, whatever you want. I mean, they'll just ask for everything. But nobody has ever stopped to think that what is the purpose of this form, and what is the bare minimum information we need to establish to achieve that purpose. Okay, so similar ideas. Okay, so this is the idea behind Occam's razor, that when you're evaluating any kind of scheme or design, does it have superfluous elements? Does it have elements which are not necessary to the proof? Okay, are you getting the idea? Okay, remember the similar concept when we discussed in the connection to ratio decidendi. Now you've forgotten everything about your lab course. Yes. When we discussed ratio decidendi, do you remember that I mentioned something? Who remembers what is the ratio decidendi of the case? Yeah, the logic behind the judgment. Okay, now if you want to make that even more specific and make that definition even more correct, okay, it is absolutely the bare minimum logic that was necessary to arrive at that decision. Okay, so the judge may have actually said certain things in the course of giving his decision, which actually, if you really analyze it from a logical point of view, those statements are not necessary to arrive at the conclusion. Okay, so are you following what I'm saying? Okay, we can give some examples also, but this is the point. So the ratio decidendi, can you see once again that this is a similar idea? That everywhere we are coming to the idea of only what is necessary. That is the idea, we're coming to only what is absolutely necessary to get it done. So these are important ideas when you're looking at somebody doing a design of a particular product, or there's some engine or some kind of proof, or you look for are they actually putting forth assumptions which are not necessary for that proof. Those assumptions are superfluous. If you train yourself to think that way, it'll make you smarter. Okay, if I might use that word. Okay, so this is the same idea connected also to a similar idea in ratio decidendi. Ratio decidendi is the absolute bare minimum logic that is required to arrive at the decision for the case, not necessarily what the judge said. Okay, so the judge may be giving a ruling in favor of somebody because of some particular legal point, and then he might say, oh, but he's also a model citizen, he has been very good in the past, but that's not necessary for that decision. Okay, so that's the point that we're arriving at. So Occam's razor, it's also connected to elegant proof in mathematics, and similarly when you're programming is a very mathematical kind of discipline. Okay, it is very logical. Okay, so when you're doing programming, and remember, everybody has to think like a programmer, because in today's age, if you're not, if you don't have any understanding of technology, that's why I've told everybody to try and put yourself through a basic programming course. The MIT, if you go to the OCW, I've sent you that spreadsheet which has all the portals. Okay, if you go to the MIT website, MIT has a starting course in Python. Okay, when you're doing all these courses, it's very important to use pedigree sources. Okay, if you're doing a course on programming, try to see if you can do it from UC Berkeley or Stanford. You have all these courses on the internet. You have the Stanford Java programming courses on YouTube, at least. Okay, it's on iTunes also. Okay, go there if you can access iTunes. So please be careful about using pedigree sources. Okay, some chacha bachija एक कोने में दुकान लगा के बेच रहा है. Don't be careful when you're doing a course on programming. I would always go first to the MIT introductory course on programming. Okay, they have a course on where they teach you how to use Python. They give you all the course materials. Try to look for the YouTube videos. Go to iTunes. Many of them have stuff on iTunes which is not there on YouTube. Okay, so always do stats courses from UC Berkeley, top engineering universities like Caltech. Okay, all these courses on programming and this. So make sure you do it from good quality university. Now because of MOOCs you have the access. Okay, I would suggest everybody go and do that MIT course on Python. You're not expected to become a hardcore programmer who's going to get hired by Facebook at for $200,000. Yeah, we are being taught Python. You're already being taught. I'm saying I'm just giving an example. So in this case, you're already being taught, but there's no harm also looking up that course. No harm looking at them. Point I'm trying to tell you is, be careful about going to pedigree sources. Now that you have MOOCs, I've given you the portals. Okay, you have access to all these top courses from top universities, and you know what the top universities are, right? I don't have to tell you that Stanford and Caltech are top engineering schools. MIT is the top engineering. I don't need to tell you that, right? So when you're doing these courses, do it from pedigree sources. You can access the materials. Okay. So programming also is connected to this. Now, what is the point? This whole discussion started with. Yes, what happened? What are the problems? You have a question?
Sir, a bottle broke down here and hit someone might be hurt.
Oh, okay. So there's a glass bottle. Okay. All right. Okay, guys. Now let's get back to programming. So this whole thing started. You might seem at the end of the day, it might seem to you that I have done like Shakespearean play Much Ado About Nothing. Okay, but these things are important. How to think about programming. How to think about because everybody should be aware now that especially if you're going to be a finance student, you should have a good understanding of programming. Okay, you don't have to be an expert, but you should know how it works. Okay, do some courses. At least it'll give you a feel for how it works. Okay, that's what is important. Okay, so here what is saying, now you can write the spreadsheet. Now eventually there'll be formulas. Last term also I rewrote my formulas. Okay, now what are you doing? You're doing A and P. The suggested, let's call it method 1. Method 1 is where you enter both A's and P's. Okay, and method 2 is what I'm following. What am I doing? I'm doing only A's. I'm not entering P's. So if it's not A, then it's P. Okay, because we have AL and all that, we can deal with that later. But let's take a simple scenario. So which is more efficient? Because you have to take a systemic view. So it's not just person who is using when you're designing the form. It doesn't make a difference to you. If you're a bureaucrat designing a form, you can always ask for everything. Okay, but it doesn't really affect you, but it affects the users because you're asking them unnecessarily to fill in all the kinds of information which is not necessary for the form. Okay, but people don't apply to their mind to all these things. So you have to do when you're designing writing a program. Not only do you have to think about the operational efficiency of the program, how lean is the code. Remember always Occam's razor, elegant proofs. How lean is the code? Can you get the task done with fewer lines of code? You have to think about that. It's the same idea. Can you see that? Can you see that it's the same idea as what I explained in Occam's razor, elegant proof? Is that clear to everybody? Right? So, therefore, which is more efficient now? Method 1 or method 2? Method 2 has only A's and method 2. Yes? Method 2 is more efficient from a user perspective because total number of keystrokes is reduced. Okay? Now, what have they done? They have written the formula in terms of P's. Okay, they have written the formula in terms of P's. Now, if I just use A's and I write the formula in terms of A's, that's what I did last term for you guys. On the left, I put up separate bunch of proofs, separate bunch of calculations, right? So you can the reason I'm telling you this, as I said, it might seem like Much Ado About Nothing, but this contains an important lesson in how you think about designing. This is also a program. Okay, what is a spreadsheet? A spreadsheet is just a programming environment. Okay, you got a bunch of subroutines. I told you what subroutines earlier. Okay, all these things are subroutines. When I write IRR, I'm actually calling a subroutine because the program has already been, the software has already been, the spreadsheet has already knows what an IRR is. As soon as you write equal to IRR, the system knows that I'm going to execute this subroutine, right? Are you following? You have to start thinking about how systems works, how systems work, how technology works, right? So as soon as you start writing equal to IRR, the system is already knows that it has to execute this subroutine. So it is asking you for the inputs that I need to execute this subroutine. That's why it asks you in the structured format. These are the inputs. You can't just write equal to IRR 5 years or something. You have to write it in a particular way. You have to fill in those arguments in a particular way. That's what system requires. But essentially what it's doing is it will then go and execute that subroutine with your inputs, okay? So it is also a programming environment, but it is a way of working. Largely you are working with subroutines because all these formulae are like subroutines, right? So in the programming, when you're designing this thing, when it is also a program, so you have to take a systemic view. What will make this whole operation more efficient? So therefore A is better than than both P and A. This is clear to everyone? You don't have to agree just because I've done it this way, but you should be able to see that it's more efficient because total number of keystrokes is reduced, right? Okay, so then therefore basically, so that's the important lesson that I wanted to give you. Okay, so much ado about nothing, but we'll go on to, but these things are important because I think these kinds of ways of looking at problems are important. So it's important for you guys to be aware of things like so this ratio density connection between all these important ideas, and then it goes to lean computer code. By now you know what I mean by lean, right? Lean computer code. Okay, if you can do the same text, because later on you'll have to do debugging. Okay, so this stuff is in your notes. I put all these things in your notes, and your job is to go and do further investigation on ideas like Occam's razor. These are very important ideas which will help you in many ways in life. So lean computer code, again, you have to think about how many lines of code am I using to get a job done. All right. So we go on to our next point on so whatever we discussed yesterday, we completed that idea about Vega. Just quickly recapping, we had Vega versus expiration. Oh, that chart should actually be here. This chart, okay, where is the chart? Okay, I didn't put the chart here, but you can actually get it from that website as well. But I'll try to put the chart here if we can. We can close attendance. Okay, I'll put it later on, don't worry. There are 16 instances of Vega. So we'll put it later on. You can find the chart here also anyway. Alright, that particular chart that I showed you, that longer dated options have higher Vega. Okay, so remember that one more thing, if we just click it up, let's see, maybe this side is also blocked. So I just wanted to show you this picture, okay, which is not big enough at this point. Alright, so obviously here what it shows you is the longer dated options have higher Vega, and since I've told you to lean toward longer dated options when you're a buyer of options, okay, because shorter dated, so that decision is mainly driven by the consideration of theta, because if you buy shorter dated options, the theta will be very high, so you don't have much time for the underlying asset view or the eyeball view to play out, because the option is losing value dramatically. Okay, so that's why you're kind of almost constrained. You have no option but to go longer dated when you're going for purchase of options, whether it's calls or puts. Okay, so the Vega of longer dated options is greater. Okay, but obviously this is a double-edged sword. Because why is this a double-edged sword? Because the option, so if your Vega view is, if your eyeball view is correct, okay, if your eyeball view here, like yesterday I was giving you an eyeball view on Microsoft options, that let's say my view is that this goes back up to 42 levels. Okay, now if this view turns out to be correct, buying longer dated options has another additional benefit, which is that the Vega of longer dated options is much higher. Okay, so I'll get a double whammy benefit. Okay, that I not only avoid the high theta of a short dated option, but I'm also, because longer dated options have higher Vega and my eyeball view has turned out to be correct, therefore I get more benefit from the purchase of the longer dated option than I would have got if I had bought a shorter dated option. Okay, so Vega, remember, is just the sensitivity of the option price to the changes in the eyeball. So what is the Vega measuring? This, you have to read from the book. Where is that option price? I opened it now. Maybe I closed it. Now that also might be blocked. Everything is blocked. Okay. Never mind. You saw that, right? You saw that. No, won't even load from the. Yeah. Okay, guys. So now. So what was I saying? So longer dated option, there's an extra benefit because it has more sensitivity. The Vega, I was talking about the Vega, right? So Vega is measuring nothing but the sensitivity of the option price. You saw that the option price has many many inputs and one output, the OVM, and so then so if the Vega is the sensitivity of the option price to changing the vol input. Okay, so changing the vol input. Is this clear to everybody? We've already discussed it. So you need to basically, I'm sure if I ask people, everybody would not be able to answer clearly what Vega is. Okay, that is my suspicion. Okay, so so please make sure that these concepts are thoroughly internalized. You have to read the book. I've referred to certain parts of the textbook. You have to read the book, you have to read the notes, you have to watch the video, experiment for yourself. Also you have the links for the option price calculator. You have to experiment for yourself. You have to tinker with it yourself. Only then does it get internalized. Okay? Alright. So but then also that understand that this is actually a double-edged sword, because have you heard this expression, double-edged sword? Yeah. Okay, good. So we say that leverage is a double-edged, in the context of finance, we say that leverage is a double-edged sword because when you're right, it works, it makes a lot more money for you, okay? Because if I can buy something by just putting up 5% of the value, okay, and then the price of that asset moves up, then I make a real big killing in terms of absolute profit and the return on my 5% margin that I put up. But when it goes against me, then the margin is very quickly wiped out. So we say that leverage is a double-edged sword. Okay. So similarly, this is also a double-edged sword because the longer dated option has higher Vega. If your eyeball view turns out to be wrong, okay, so if your eyeball view turns out to be wrong in this sense here, if I buy the options here, then the eyeballs drop, okay, and the eyeballs drop to say 15%. Then my longer dated option has lost much more value compared to a shorter dated option, if you ignore the impact of theta. Because when you're looking at these sensitivities, these are all basically on a ceteris paribus basis. So when you calculate the Vega, you're assuming that everything else remains the same. Everything else remaining the same, the change in the value of the option for a change in for unit change in the vol input into the OVM. This is clear? Okay, so that therefore this is also a double-edged sword. So bottom line is, the reason you end up buying long dated option is really not because of the Vega, okay, but if your view is right, you'll get an additional benefit because longer dated options have higher Vega. The reason you are basically forced to buy longer dated options is because you don't want to get hit by the high theta of short dated options, right? Is this clear? Okay. All right, so this is our next point. Okay, so this you guys can click and open this and see, look at the video, the proof. Okay, sorry, look at the picture and internalize that in your head. Okay, yeah.
This means that Vega is only there to help us check if we are assuming it in the correct direction or not. Rather than, because we are only checking the eyeball and that expiration period of the option.
No, sorry, I'm not able to get your question. Repeat the question. Give him the mic. Let's use the mic. Let's make use of the mic. Meantime, let me try and. Okay, go ahead. Tell me what the question is. Yeah, what is your question?
Sir, we had a decision problem like which option we should go for, where we are checking the eyeball and I think.
Yeah, your voice is not coming through the mic in the way that mine is coming through the mic.
Okay, sir.
Yeah, now it's better. Now it's better. Yeah, we have the list of decision problems here. So what are you saying?
Sir, in the third one, whether to buy or sell option, we are checking the eyeball value.
No, you're not checking the eyeball value. You are taking a view.
Eyeball view.
You're looking at the eyeball chart and taking an eyeball view.
Yes, sir. So we are assuming something. So we are having Vega to cross-check our assumption if we are assuming it in the correct way or not. Because right now, like you said, that Vega is not that important to check which option to buy or not.
Yeah, because what I'm saying is that the decision to buy longer dated option is basically almost a Hobson's choice. You know what the Hobson's choice expression means, right? Are you familiar with Hobson's choice?
No, sir.
So Hobson's choice means no choice. Okay, so this is a Hobson's choice because essentially the reason I'm forced to buy longer dated options is because I don't want to get hit with the short dated options, the high theta if I buy a short dated option. Okay, I'll have a high theta. So I don't want to get hit by that. So I have almost no choice but to go longer dated when I am a buyer of options. This is clear. This is how the decision is made. Then we are noticing that having taken this kind of, having been forced into this kind of decision, then we are noticing, because we have to be aware of the behavior of Vega as well, right? Some part of your basic training and options trading has to also include this idea that longer dated options have higher Vega. This, as we say, a picture says a thousand words. If you internalize this picture, you'll understand that longer dated options have higher Vega. Okay, so now having been forced into buying only longer dated options, we are just taking note of the fact that longer dated options have higher Vega. So if my eyeball view is correct, so this is kind of like leverage being a double-edged sword. If my eyeball view is correct, I will have the fact that I bought a longer dated option has an additional benefit because the Vega is also higher than a shorter dated option. So, and what is Vega? Vega is the sensitivity of the option price to changes in the vol input, okay, into the OVM, right? So if therefore the option price will also respond more dramatically to a change in the eyeball in my favor. So what I'm talking about here is I took a bullish view on the eyeball for Microsoft options, okay, and then if the eyeball actually turns out to be correct and it shoots up to 42%, the eyeball, what will happen? Ceteris paribus, the Microsoft option prices will increase or decrease. Is my question clear? Yeah. So if I buy Microsoft options, okay, let's say I forget about calls and let's say I buy both. I buy both calls and puts, okay, and then after, when I buy it, the eyeball is 28%, and after I buy it the next day itself, for the sake of simplicity, we take an extreme example. For the sake of so the next day itself, the eyeball shoots up to 42. Now my options, are they worth more or are they worth less? They're worth less. They're worth more, right? Okay, this is clear because Vega is basically positive for long options position. So whenever your the eyeball goes up, the option price will also go up. Okay, please make sure your understanding of eyeball is correct. I've given you two ways to look at eyeball. Please make sure you go and revise those, because if your concepts are not clear, you'll have a problem later on. Okay, that the eyeball is only basically the eyeball is arrived at. Remember what we discussed, which Tanya pointed out, that we do the same exercise in IRR calculations. You have to remember how we calculated eyeball. We saw that the market price is showing say 3.02 or something, but when I input my estimate of the vol into the OVM, the price is coming out to be maybe 2.5. okay, so this is not good enough. So basically, what are we asking when we are calculating eyeball? This is what you have to remember, really, what you have to understand as a concept, that in calculating eyeball, you're asking yourself, you look at the market price and you have an OVM in your hand, okay, and you enter certain values into the OVM, including a particular vol input, okay, and let's say you have entered a vol input of 25% and you get a price of 2.5. But when you look at the market, you see that we're not able to do this exercise by looking at, maybe we can do something here, eye volatility. So that's why I make sure I open all the sites before I come here. Okay, all the sites that I need. Okay, where do they show any option prices? Okay, now I don't want to move this from here, from this view also. They do show option prices, but here they're showing only vols. Okay, They're only showing a walls and that's it. Okay, never mind. Okay, so another eyeball chart. All right. So what are we doing? Please remember this concept of eyeball. Revise it once again. So what are we doing? And we ask ourselves this question, that if the market price is 3.02 and with my wall input of 25% into the OVM, I'm getting a market price. I'm getting a fair value. Remember, OVM gives you fair value. Okay, I'm getting a fair value of 2.5. Okay. Now I ask myself, okay, so that's a legitimate question to ask. Like if the market, so the question is very specific. If the market were also using the same OVM that I'm using and setting the price equal to fair value. So understand two steps. One is market is using the same OVM that I'm using, okay, the same model, okay, and then the market is setting the market price as equal to fair value. Okay, second step, if those two were true, then what wall input is the market entering into the OVM to come up with that price? Is the point clear?
Yes.
Let's do this one more time. Although I've done it once, I've done it before, but let's do it one more time here. Okay, I'm going to try. These things are so important actually that okay, let's not reboot. Let's not try and open that again through this. I'll just switch it back off. I'll just write it once again. This is another, maybe I have explained it in this way, but let's do it one more time because we have to make sure that. So before we come to this understanding of Vega, okay. We were discussing Vega, all right, and then we came once again to the eyeball view. Okay, so this is there are different ways of looking at eyeball. This is the first. This is kind of the I don't know how I listed it. Okay, this is, I think I would have listed it as a mechanical. Let's go back in your notes and look at it. I'll just, in that case, I'll just amend your notes if I need to at all. Okay, so let's go back to the, so this chart now I've given you, strictly speaking, only true for at the money options. Okay, for in the money options, okay, there's a little bit of a difference in the curve a little bit towards the end, but start with this as a working strategy that you want to be buying, you want to be selling shorter dated options and you want to be buying longer dated options. So in giving you a structure, I have made certain simplifying assumptions because I want to start you, because option trading is quite complicated. So I wanted to start you guys out with a structure. Okay, so therefore there are certain simplifying elements, and obviously when you start looking at the money versus out of the money, in the money, there are all kinds of variations. Okay, so that will get very complicated. Yeah, I'm just coming to your question. I'm just trying to find yeah, what is your question? You tell me the question.
So yesterday when you opened the option value calculator, it was giving a similar same Vega value for both call and put options. So where to differ, which one to go for? Either to go for call option or for put option?
No, that is decided by a different, you don't decide that by looking at the Vega.
But sir, you said that higher the Vega for a longer dated option means the higher, we'll be getting a different eyeball view.
No. Higher Vega has nothing to do with the eyeball view. Higher, I would never have said that. The higher Vega is just a property of longer term options. If you have an option which you can see in that chart, right? That this is the chart which shows you these are the properties. Okay?
So it is mentioned that longer dated options have higher Vega.
Yeah. So it's okay. There's no problem. That's why you should ask questions so you can clarify. Because the first time when you hear something, you may have a different impression in your head. Okay, which is not the right impression. That's why you have to ask questions so you clarify that impression. Okay. So let's be clear about that. I would never have said that eyeball view is based on higher Vega for longer dated option. Eyeball view is based on essentially, you really can't use fundamental analysis. It's based on a technical analysis of the eyeball chart. Okay, so you look at the eyeball chart, look at the trends, and you take a view on which way eyeball is headed. Okay, is it going to go up or is it going to go down? Okay, so that's what the eyeball view is based on, and that puts you into one camp. If you are bullish on the eyeball, then it puts you into the buyer of options camp, and if you're bearish on I vol, it puts you into the seller of options camp. Yes? Okay. So just quickly to recap your decision problems. The other important decision, there are many other decision problems, but the second important decision problem is whether now that you're a buyer, let's say you're a buyer of options, should you buy calls or should you buy puts? And that is decided by taking a view on the underlying asset. So here Microsoft, that we have already discussed. Okay, so now that I have taken a bullish view on I vol, that makes me a buyer of options. Second important decision problem is, should I now buy calls or buy puts? So for that, to answer that question, I take a view on the underlying asset price, Microsoft. I take a view on this, and let's say I'm bullish on this. You could also be bearish.
But sir,
let me finish this. Okay, and so I take a, let's say if I'm bullish on this also, I take a view on the underlying asset and I'm bullish on this. That solves my problem, whether to buy calls or puts, right? So I should be a buyer of, if my view is bullish, then I should be a buyer of what?
Call.
Somebody said put.
Call.
Who said put? Rajan. Okay. So so put the calls. Yes, Gulati?
how to
If I'm now let's ask you. If I'm first decision problem is clear. Should I be a buyer of options or should I be a seller of options? Okay, so I take a view on the I vol chart. Okay, and this is just like a surfer. You have to look at it like a surfer. Okay, and so if you're bullish on the I vol chart, then you buy. Then you're a buyer of options. You still have another problem at least left. Should I be a buyer of calls or puts? For that, we take a view on the underlying asset price. Which way is this going to go? Is it going to go up or down? So let's say here I decide that it's going to go up. Then I should I be a buyer of calls or a buyer of puts? 1 minute, let him answer. Is my question clear?
Sir, I would like to refer the theta value for that one.
1 minute. You answer my question first. Is my question clear? I took a view on the I vols and I decided that I'm going to be a buyer of options because I'm bullish on the I vols.
Yes, sir.
Now I have another big important problem to deal with. Should I be a buyer of calls or puts? Okay. So for that, the rule is that I take a view on the underlying asset and I come to the decision.
Yes, sir.
Okay. So I took a view and let's say I'm bullish on the underlying asset.
Yes.
So now answer my question. Should I now be a buyer of calls or should I be a buyer of puts?
Sir, I would say call, but once I would like to.
Okay, that's fine. That's now move on to the next
Sir,
step.
I would like to go and check the value for theta as well because in the calculator.
Yeah, so we'll come to that. The theta, at this stage you don't need the theta. At this stage you don't need the theta. The theta is required when you are looking at the question of 1 minute, guys. When we are the theta at this stage you don't. So that's what you should be clear about because you don't want to overcomplicate your life. The reason I've given you this kind of structure by making certain simplifying assumptions is that I don't want you to overcomplicate your life. Okay? You are going through decisions one by one. Okay? So first you decide whether you want to be a buyer of options or seller. You decided that. Then you had a problem, should I be a buyer of calls or puts? You have decided that to buy calls because your view on the underlying asset is bullish. Okay? Your view is that Microsoft is going up. Okay? Now, which is the same, by the way, you should be watching RBC. Who's RBC? Yes? Somebody said Royal Bank of Calcutta. Royal Bank of Canada. Okay?
It's red blood cells.
RBC.
Oh, RBC is red blood cells. Okay. But in this context, obviously, when you see a headline like RBC raises Microsoft target, this is Royal Bank of Canada. So their securities division. So Royal Bank of Canada is the most important Canadian bank. Okay. So their securities division has obviously taken a view. Their technology analyst has taken a view that Microsoft is more bullish than he initially thought. So this is one of the events that you will see happening in the markets regularly if you're following the markets, that various analysts and brokerages will come out, various analysts working for different brokerages will come out and either raise their target or lower their target. So they're raising their target price in this case. Okay. So as I said, so bullish, RBC is also bullish on Microsoft. Okay. So now what is the point you're talking about theta? That theta question comes up only when you're looking at the next decision problem. That now that I'm going to be a buyer of calls, what is the decision problem that we are talking about now? Where theta becomes important?
Long and short, the expiry date.
Which expiry date? That's the decision problem, right? When you're talking about that, now you have to decide that as well, which expiry date. That's when the concept of theta comes into play, that you know that shorter dated options have very high theta. So if you're going to be a buyer, in this case I'm going to be a buyer of calls, then I should not be into the short dates because they will have very high theta, okay, and my option will lose value very fast every day. Okay, so it will lose substantial amounts of value every day. So therefore, since I'm going to be a buyer of options, okay, as a result of solving the other decision problem, the earlier decision problems, I should put myself into the longer maturities. Just clear? Okay, right? So now does that clarify all your doubts? Any confusion?
Sir, the last one regarding the difference between the value of the theta value of call and put option.
1 minute, let me just try and see if my
Trading connection lost. Market data connection.
Have you guys heard of this company called WeWork?
Shared office spaces.
Yeah, some people have heard. But there's a very big valuation lesson in WeWork. Okay, do you know what the valuation of WeWork was? And these are actually, WeWork is not yet public, so these are PE. Every time you get a PE valuation, like you heard that Swiggy has become a unicorn, where do these, what is the event that is triggering these public releases of the valuation information? Can you tell me why are we coming to know about this? Like, on what basis are people saying that Swiggy is now a unicorn? You know what a unicorn is? Yes?
Yeah, it's correct.
Yes, who? 1 minute, let Burma speak. Burma doesn't speak much. Yes?
The startup which got the valuation of $1 million.
Correct. Okay, so a unicorn in the current environment, the definition of a unicorn is a startup which has, and you have to be more specific, it's a private company. Okay, so typically we don't, because the public company valuations are already known. It's a private company, okay, typically a startup which is worth more than $1 billion. Okay, so there are many unicorns around the world now. So the reason that we come to know, so the question that I was asking you is, the reason that we come to know about these valuations, that WeWork was worth 47 billion in January of 2019, okay, and now it's worth now they're talking about 8 billion valuation. So the reason we come to know is that some PE or venture capital firm, PE, you know, what is PE? Private equity. Okay, so some private equity or VC firm puts money into the company. Okay, so that's how we came to know that Swiggy is worth, because there's a funding round. Okay, so you have all these Series A, Series B funding. Okay, you have these funding rounds. So some people, like in January we came to know because SoftBank put in money into WeWork, and that time they valued it at 47 billion. Okay, based on the stake that they bought, okay, and the amount of money. So obviously you work it out. If somebody is paying 10 rupees to buy a 10% stake in the company, then the company is worth 100 rupees, right? So that's how they work it out. Okay, so the trigger, the question that I was asking you is, why do we come to know? Because some guy has put in money. Okay, so this is the point that we were discussing. So on this video, I'll share this with you. Watch the first part of the video. WeWork is a classic lesson in valuation. Okay, because just imagine, this is what I mean by valuation being subjective, and see how unpredictable things are. In Jan of 2019, WeWork was worth, if you go back here to the initial part of the video, is I think where WeWork is. Yeah. This part, you can watch this. All right, so you can,
that is a far cry from the 47.
yeah. Watch this. I'll just play this for a while.
I'm Taylor Race in San Francisco. This is Bloomberg Technology. Coming up in the next hour, lowering expectations. SoftBank puts together a rescue plan for WeWork that may value the co-working company below $8 billion. That is a far cry from the $47 billion valuation it had in January.
See, can you see this? In Jan, you heard everything? Even you could hear? Okay, so in Jan this was valued at, and this is not some casual, okay, I'm sitting over coffee, what do you think? These are people putting money into it. SoftBank has invested $10 billion into WeWork. Okay, so this is serious money being invested into the companies, and that's how we come to know about the valuation. So this company was valued by, and these are all professional investors. SoftBank is running a vision fund, okay, which is a professional investor. I think the speed is too much. The speed is too much. Okay, so these are professional investors. Understand that, okay? Right? These are professional investors. All right. So they are investing money into, and big chunks of money are being invested, and you see what the value. You can listen to the whole report. Okay. This is why I tell you to watch these programs, because you get to know about what's happening in the world. It's very important to be plugged in. Then you're constantly applying the theories that you're learning, trying to make sense of the world as it unfolds in terms of the theories that you're learning. Okay, this exercise is very important. Okay, so, but this I wanted to show you as a valuation story. So here's a company, and this is all serious money being invested by professional investors. The company is valued at 47. How is it possible? Okay, and it's just a real estate company. It's not like I'm setting up a hedge fund to trade crude oil futures. Every day I'm buying 1 billion worth of futures and 2 billion worth of futures, where you can lose huge amounts of money in one day, right? So make or lose huge amounts. This is a real estate company, okay? So now how is it possible that the valuation of this company starts out in January of 2019 at 47 billion from professional investors, and now they're talking about $8 billion? You realize, well, so when you're doing all these valuation exercises, you have to be grounded in the real world. You have to always have this, because what I detected from your seniors was they did not have this sense clearly in their head of this concept of fair value and the fact that fair value is subjective. Okay, I've taught you that. Remember that fair value is very different from market price. Okay, fair value is what I think the company should be worth. What I think the company should be worth. Okay, so now not only is that a normative thing, it's a subjective thing. Okay, normative obviously usually will be subjective. It is subjective because what I think, now Shuchi might come out with a different valuation. Okay, Sakshi might come out with another different valuation. So there's no reason for all these valuations to converge to one point. So understand two things, that first of all you're doing a fair value calculation, and second is subjective. Okay, so this concept has to be there in your head, and you can see how subjective and how dramatically and how unpredictable things are, how dramatically the valuation has changed. Another thing I want to show you briefly is there's a point where she's talking about, you can listen to this whole point. I won't go there, but you can just listen to it. I don't want to waste time playing this right now. But you can go and listen to this part, the discussion on WeWork at least, where at one point this anchor is asking, she's got two reporters, okay? At one point she's asking them, do you think it's getting closer? What she's asking is, it was worth 47 billion. Everybody thought it was kind of high at that time, okay? But obviously the investors did not, because they put in money at that valuation, right? So at least somebody didn't think it was too high. And now she's saying, now that we are talking about 8 billion, is it getting closer to fair value? So she's asking this question, now is it getting closer to fair value? Now you'll find many business anchors talk like this. Now this question is also kind of stupid, because your fair value is not my fair value. Okay, this is not the kind of statement. It's like if I ask somebody, will you return before Christmas? Now everybody knows what Christmas is, when Christmas is, right? There's no subjectivity there. Now when many business anchors will talk, you'll see when they have these discussions, it's getting closer to fair value. But fair value is not something which is homogeneous, in the sense that your fair value is not equal to my fair value. Normally we don't expect it to be equal. If it's equal, it's a coincidence, okay? Because there are thousands of investors, everybody is doing their own fair value estimate, and you would normally expect all of them to be different. So when they talk about, you'll see at some point she talks about fair value. Is it getting closer to fair value? Fair value is not, it's not like asking somebody, will you return before Christmas? Okay, because everybody knows when Christmas is, right? It's not the same. So understand that it's not the same kind of question. Is this clear? Okay, so we had a little bit of a digression from the RBC. So in our class we have a lot of digressions, because I specialize in digressions. Okay, so but hopefully you can understand what we have discussed in this digression, right? That the concept of valuation, you can listen to this. So I'm going to put this, you should actually be listening to all of this stuff. You can learn a lot actually about how, we'll put it into today's notes. So there's a discussion about, so I'm putting this into this. So this is a lesson in valuation and the subjectivity of valuation. The first part of the video. What is happening? Why is it like this? Anyway, never mind. We'll just put it here. Okay. So for Vega and eyeball, I was trying to go back. Okay, Gulati, is your problem solved? Not yet solved. Okay. Okay. No, now I'm on my GeoFi. It seems to be working. So let's come. So this is one of the ways. So this is the way that. So sometimes you have to deal with this situation where one of your batchmates may not be clear about certain things. Okay. So we will say, but you may have understood that thing. But in that case, you have to be patient and wait until that question has been clarified. So you should not make fun of him that So because it depends on how you teach the course. You can also have this view that I'm going to teach like one of our teachers was you say, "Maine to padha diya." But what has the student understood? So the objective of teaching is, to me, the objective is that everybody who is interested, has some interest, should be clear about what has been discussed. And the only reason you come to class is for the benefit of asking questions. Otherwise, there's no need to come to class. You can just watch the videos from home, right? So the only reason that you come to class is for questions. So therefore, questions are, now you see, I talked about my GeoFi. Now it's gone for, now that also won't open. Does anyone have a data cable? Oh, it still won't really affect us. You have anyone has a data cable? So again, two people have gone out together or what? Two people have gone out together. Okay, Ritesh, just watch. We don't have much time left, but just make sure that not more than one person goes. Okay. Now it's not working. Anybody with a data cable? If we can plug one of the problems. Okay, we got it. Okay. So we got the option price site opened up. Okay. Now tell me, what is the question that you have?
So here we are having minus 0.05 theta value for call option.
Don't say here we are having, here we have.
Sorry, here we have minus 0.05 value for call option and minus 0.04 for put option. And according to the view on the underlying asset, we decided to go for the call option. But
no, 1 minute. Okay, your statements independently are correct, but the way you have uttered them, it seems to me that you think that the first one is because of the second, or the second one is because of the first one. That we decided to go for call options because the call options have lower theta. That's what you seem to be saying.
No, sir. We decided to go for call option because we had a bullish view on the underlying asset.
Yeah.
But looking at the theta value, call option is having a slightly higher value.
Okay, I understand. Now I understand what you're saying. So there is a logic to his question. Okay, it also shows that he's thinking about the problem and applying his mind, tinkering with the software, and so your question is a good question. Okay, so it's a valid question. So what he's saying is that although we decided, because we were bullish on the underlying asset, we decided to buy a call option, not a put option. But he's saying, but look at this, the call option has a higher theta than a put option. Okay, so maybe you should buy a put option. That's the question that you're asking. Very good question, very valid question. But that's not what we are, the dominant consideration, okay, that we are applying. Okay, here again you have some subjectivity. You can also set up a trading system for options where you choose to buy the one which has the lower theta. Okay, but the way we do it is the conventional theory is that because the underlying price will have a much bigger impact on the option profitability, okay, the movement of the underlying asset. Okay, so therefore the way we have set up the theory is that the decision as to whether to buy a call option or a put option is made on the basis of the view of the underlying asset, the view on the underlying asset. Okay, so your question is valid, but it's just a matter of prioritization. Okay, because as you can see clearly that these two rules, the decision rule that Gulati is suggesting, that you buy the option which has the lower theta, okay, that would lead to a different decision in certain situations than the decision rule which I have given you, which is to buy, once you're a buyer of options, to buy call options if you're bullish on the underlying asset, yeah, and to buy put options if you're bearish on the underlying asset. This is clear? So the two decision rules have a different, I'll just come to you. The two decision rules come out with different conclusions. So therefore there is a question of prioritization. There has to be a hierarchy. Okay, just like if you go back to all this stakeholder theory, you talk about shareholders versus stakeholders. You heard this debate, right? Stakeholders, okay, everybody. So there's in that debate somebody even said that even terrorists are stakeholders. So you have to take care of terrorists are also stakeholders. Okay, so but there's a conflict, so there needs to be a hierarchy. Okay, and so therefore we are choosing the hierarchy that I've given you. I'm saying that rule is more important. Okay, now let's take Sakshi's question. Yeah, give her the mic. Give her the mic. Yeah.
Sir, you said that theta of call.
Your voice is not coming through the mic, even though you're on the first
You said
one.
that theta of call option, it is greater than the put option.
Don't talk. Don't talk when somebody's here. Yeah, what are you saying?
Sir, you said that theta of call option is greater than put option.
No, we are noticing this here. We are noticing this here. Okay. So in this particular case that we are noticing this here, we can actually, there is one difference between call options and put options, in the sense that the put option has, because the underlying, in the case of stocks at least, okay, and most of the underlying can only go to zero, whereas on the upside there is unlimited potential in the case of call options. But what is your saying? So in this case, let's say we have theta of call option is higher than theta of put option. So what is your next step from there? What are you saying from there?
So, sir, you have said that according to Karthik, he said that the theta of call option.
Use the mic. Yeah. Theta of call option. Yeah.
Theta of call option, it is.
This is not coming through the voice has to come through the mic. This is part of your learning. Also, when you're speaking with the mic, you should be able to detect whether your voice is coming through the mic. Yeah, go ahead.
Sir, in this case, the put option theta, it is greater than the call option, but he said it reverse.
No, which is greater? Which one has a higher theta? In this case, what we are looking at on the screen, which one has a higher theta?
Put option.
Put option has a higher theta. Okay, so you don't have to take this when we say higher here. When we say higher here, we are not. One sec, guys. 1 minute.
Sir, this was the same doubt I had earlier. Like according to our number.
1 minute. No, 1 minute. Okay, guys. One sec. Don't make fun of him. Okay.
Sir, I asked this question earlier. You said that if we look at in a mathematical number line way, put has a higher theta value. But if we look at in the financial terms, call option is losing value of around 5 cents. And
Okay. So you did ask. Okay, I forgot about that. So I did mention the number line concept. Gulati, I did mention the number line concept. Okay, good. I'd forgotten that. So it's when we say higher theta, because first, in order to understand this depiction in the model, when the model outputs come out, okay, you have to understand what is theta. The theta is that's why you notice both calls and puts have negative theta. Okay, so these sensitivities are for, I've told you many times, these are for long option positions. Okay, this is telling you what will happen if you do a sensitivity if there is a change in one of these inputs without any change with ceteris paribus. There's a change in one of the inputs. What will happen? What will be the impact on the option price? So you notice these are for long option positions, and you notice both calls and puts have negative theta. So the first thing, forget about the magnitude. Let's just look at the sign. So the first thing that this thing is telling you is that if you buy calls or whether you buy calls or puts, okay, ceteris paribus, with the passage of time, both will lose value every day. Okay, so this is showing you the change, the sign of the change in the option price or the fair value of the option for a change in the input, for unit change in the input. In this case, we are talking time as an input, time to expiration, which only moves in one direction. So 1 day less in the option, 1 day less if after you buy the option, 1 day elapses and nothing moves. Okay, if you buy the option, 1 day elapses, nothing moves, then the option will lose value, the call option will lose 0.05 in value. Lose comes from the minus sign. Okay, and the put option will lose 0.04 in value. This is clear. So are you is this clear? Make sure, I'm not sure everybody has understood this clearly. Okay, so Gulati is correct that it is actually the call option has higher theta. Okay, because when we are talking about higher, first you have to be clear about what theta is. Theta is the the number theta is showing you the loss of value in the option for 1 day, less than the time to expiration. So basically passage of 1 day. Okay. So therefore, how much value will the call option lose? That is given by minus 0.054, and how much value will the put option lose is minus 0.04. Okay, so this is not in the number line sense. You are correct. If you take it from a number line sense, obviously the put option has higher theta. It's a higher magnitude. It's closer to 0 on the number line. Okay, on the negative side. Okay, so but this is further away from 0. Okay, so therefore the magnitude it is lower. Okay, it's an absolute magnitude. Okay, but here the sign is also relevant because your question is which option will lose more value for 1 day of time passing. For 1 day of time passing, which option is going to lose more value? Is that clear now to everybody? That's called. Okay, so it is not in the absolute magnitude sense. Okay, so this is clear. Yeah, so the reason you were highlighting it is because of just to point this out basically. Okay, I had also actually forgotten that we had discussed the number line concept. Okay, so we are moving a little slowly, but doesn't matter. That's why we want to encourage questions because the whole point of people coming to class is that they have the ability to ask questions. Otherwise there's no need to come to class. Okay, so what do we have? So we had a little discussion on the WeWork valuation. I think these are important. This is how you connect to what is happening in the real world. Okay, so Vega and iVol. Now I wanted to go back to the discussion of Vega that I had given. So because I think you need to understand this also. Where is that part on? Yeah. So yeah, we are talking about this mechanical answer. Okay, to understand iVol, we are talking about this mechanical answer. I just want to make it clear to you, okay, that I think I need to discuss this part as well. Let's have this discussion. Okay, so now we are going into the iVol discussion. So the question is, so I'm going to teach you 3 ways to look at iVol. Okay, and one is a mechanical way of looking at iVol, and there are 2 intuitive ways of understanding iVol. Okay. So the mechanical answer is also very important, okay, which is, please understand this in terms of English language, that then we'll understand conceptually what it means. Okay, so this is clear to everybody. The iVol is the vol input in the OVM, which makes the OVM throw out a fair value for the option that is equal to the market price for the option. Is this clear? We have already discussed this. So this part is coming, so later on, and maybe I'll write it when the connection comes back. Or have we opened everything? Then I'll try to go back to the normal connection, since we have opened everything. But if we make any changes, let's just go back to the normal. We will not make any changes. I think what is clear is that my GeoPhy signal strength is even weaker than the test connection. Alright, let's go back to this. So the only thing I was saying in the context of this is that how are you being very clear, because this is very important to understand mechanically, at least also what exactly is iVol, okay, because you may be getting confused. So you have, on the one hand, you have the market price, but the market is, options are trading in the market, and through buying and selling a price is always being determined. Okay, so then you have the price discovery process in the market, you have option prices, and then you have your fair value model, which you punch a value into your fair value model. and you come out with an output. Okay, so let's say here we have, this is the fair value model, and I have a vol input of 25, and then I see that my price is 3.02, or let's just call it 3, and let's say that the market price for the same option, same parameters, the market price for the same option is showing as $5. Okay, so now what do? I ask myself this question. Okay, so let's say the in this option price, let me put it here, then we'll discuss the other parts. Okay, so the question that I'm asking is this, that let's say we have a market price for option as 1. Okay, we have the market price option, and then we have actually the OVM output for fair value of option. Okay, we have these two different things. They need not be the same, okay, because they are being derived from different processes. They need not be the same because market price is coming out of constant buying and selling pressure in the market, and OVM output is coming from the user entering certain values into the OVM. So the result may not be the same. Okay, so we have this. All this stuff is in your notes itself. Okay, so you don't have to write this, but just make sure you understand this once again mechanically. So you have these two things. So now I do this. I do this second one. Okay, I do the OVM output for the fair value of the option. Now, according to me, the fair value of the option is here. The big unknown is, everything else is known. The big unknown is the vol input. Nobody knows what the vol input. This is the future. This is the future input that the model is asking for. Okay, just like in your CAPM cost of equity model, what the model is asking for is what is the expected return, what is the equity risk premium expected to be in the future for the period for which you are doing this cost of equity calculation. That is the question the model is asking. Okay, and we are answering that by taking some last 20 years equity risk premium or last 40 years or something. But you realize how wrong that is, because just because it has been so for the last average 20 years, that doesn't mean that it should be the same for the future. So all these things you have to be aware of when you're using models, okay, where we are making all kinds of conceptual errors, but everybody is doing it, so it's a big happy family. So it goes on. All right, so here the big question mark is the vol input. Nobody knows. This is meant to be, the model expects this to be a forward-looking estimate of the vol that will happen in the underlying asset, the volatility of the underlying asset price. It's a future, it's an estimate for the future, okay, which is required to be put into the OVM. Okay, so I put it in as 25 because according to me it should be 25. Okay, this is one more thing that you guys should think of. Remember, yesterday we were talking about models, and when you evaluate models, you have to think about whether the endogenous variable is something that is observable, or is it some kind of nebulous concept, like what should the cost of equity be, like a normative concept. Like I told you, if you have an endogenous variable where endogenous variable is rainfall at gate number 2, that's an observable endogenous variable. So you can test that model, because every day you're saying there'll be 2 centimeters of rain. Now I'm getting only half a centimeter. That means your model doesn't seem to be very good. So you can test that model objectively. These things are also important. So here you have another thing that you should notice when you're looking at models is, here the vol input, the vol is what? An exogenous variable or endogenous? Let's ask somebody. Puneet. In this OVM, okay, the fair value model for options, in this, the vol, is it an exogenous variable or an endogenous variable? Exogenous. Okay. Shivam, you agree with him?
Yes, sir.
Okay, good. So it's an exogenous variable. Okay. Now notice what this is. Normally what I would expect, I mean, this is I'm showing my normative preferences, so I'm showing my bias. But what I would want in a model is, if you're, let's say you're modeling, say, next quarter's consumer spending, okay, I would prefer to have my exogenous variables clearly observable. So you model next quarter's consumer spending as a function of maybe this quarter's inflation, or the previous quarter's inflation, previous quarter's household income, previous quarter's unemployment rate, because all those figures are known to me, right? You understand what I'm saying? Known versus forecast values. Now we're talking about one more aspect of models, which is when you're evaluating models, exogenous variables, are they known or are they forecasts? right? Because the model itself, the endogenous variable is obviously a forecast, okay? It may be a forecast of an objectively observable quantity like rainfall at gate number 2, or it may be some nebulous quantity like what should the cost of equity be, right? Okay, but at least now when you're focusing on exogenous variables, you should also ask yourself this question of, are these observable? Like if I model next quarter's consumer spending as a function of last quarter's unemployment, last quarter's household income, last quarter's inflation. Here all the exogenous variables are known. Is that clear? Okay. So when you're evaluating models, also watch out for this. Are the exogenous variables known quantities or are they themselves forecasts? Okay. So in your Gordon growth model, exogenous variables, are they known or are they forecasts? Known. Both. One is known constant dividend rate.
But the
Growth rate is a forecast. Okay. So watch out for all these things. Okay. That's basically what makes a model tends to make a model more subjective, because your input itself is a forecast. Okay. So here is another example of a model, the famed option pricing model. Okay, which really is an option valuation model. Okay. So here the vol input is always a forecast. You're deriving a fair value based on your estimate of the vol. Okay, so you come up with a fair value of 3.03, let's call it 3. But the market price for the very same option which is trading in the market, you find that the market price is 5. Okay, so we have this situation, market price of option, this is only, this is equal to 5. Can't see anything. See, for your convenience, I am straining my eyes. Okay, OVM output for fair value of option is 3. Okay, everybody understand the example we're talking about? Okay, I observed that the market price is 3. So now comes the question, how exactly would you understand IVOL? Now comes the question, if the market were also using, now we split the question into 2 parts. If the market were also using the same OVM as I am using, okay, and 2, okay, that 2 is not the same case, setting price equal to fair value, or let's make it even more specific, always setting price equal to fair value. If these two are true, then what input is the market entering, or what value is the market entering into the OVM for the vol input. Is this point clear? Is this clear now? This is how you should understand mechanically. Make sure you revise it properly. So what am I doing? I look at this, my fair value is 3, but when I look at the market price is 5. Now I ask myself this question, if the market were using the same OVM that I am using, 1. Number 2, if the market were always setting price equal to fair value according to this OVM, then what must be true? What must be true for the vol input that the market is entering, what must be true for the value that the market is entering in this vol input cell? It is entering something other than 25, obviously, because 25 gives a fair value of 3 and the market is trading at 5. So if we assume that market is all using the same model, number 1, and number 2, always setting price equal to fair value, then what vol input is the market using? Can we conclude? What can we conclude? What we do for the same exercise as we learned, okay, same as IRR, we can't find this analytically, we have to do trial and error. So the market vol input is higher or lower than what I have? higher, okay, because in order to go from a value of 3 to for the option price to a value of 5, okay, everything else being the same, you need a much higher vol input, okay. So this is what I vol is, and this is how I vol. So these I vol charts that you're looking at, how are these I vol charts calculated? How is each value? This is a time series chart or a cross sectional data chart? The I vol time series chart. Okay, how is this plotted? Every day you take a look at average options of Microsoft, average prices of Microsoft options. Okay, you know all the other parameters. The only thing that's not known is the vol input. Okay, and then you take your OVM and you make a first guess. Maybe the vol is 35%, and then you see it doesn't come out to that price. Okay, so you do this exercise every day, and then you eventually converge to the the vol input that will give you the same OVM output that is equal as the market price. That's the exercise you go through to come out with this I vol chart over time. Okay, so this is what I vol is essentially. That's why we say now when you understood the mechanical part, okay, you can also understand the first intuitive answer to what I vol is. I vol is an index of option prices. Why do we say that? Because as you can see from the mechanical part, higher I vol means ceteris paribus, higher option prices. Yes, higher I vol means higher option prices. Okay, so go through this and understand this, because these concepts are a little slippery and you guys are encountering them for the first time. So unless you internalize, and the value of investing that time is that once you have mastered it conceptually, then you will never forget it. Other than that, if you just mug it up and try to do something in the exam, then by next semester you would have forgotten it. So what is the point? You're wasting your time, right? There must be some solid value addition from the program. As a finance student, you should be totally proficient in all the important concepts that have been taught to you over the course. Otherwise, the whole program is a waste of time for you, right? Yes. So already, Garvit's responses are becoming more emphatic, which means we are reaching the end of the class time. Okay. So please remember to watch these programs regularly.
Yes.
Okay. All right. Okay. So anybody has any technical questions? So please, if anything we've learned, one sec, guys. So if you have learned anything from, if you have learned anything from today's class from Gulati's persistent questioning, is that you should follow this example. Whenever you have any doubt, you should ask a question. It doesn't matter what other classmates think, whether your question is smart or stupid, or that's not important. You are here to ask questions and clarify your doubts. Okay. So make sure everybody should take Gulati as their hero and follow his example. Okay. Yeah. Okay. All right. Okay, guys. Anybody any technical questions? No technical questions? Any problems with the trading project? Not making enough money. That's also a problem.